The first stage, obviously, is the so-called melt-up. And you're seeing a lot of people out there talking about a melt-up now. I'm not saying I coined the phrase, but I think I was probably responsible for an awful lot of people picking up the term that was not used a lot prior to this past year. And I call melt-up something that is highly unusual. What I see on the street these days is an awful lot of investors and pundits using the term melt-up and then saying, a 200-point rally. That is not a melt-up. That's just a nice rally. I mean, we've had a nice rally here in the last couple of weeks, but it's not a melt-up. I think the melt-up kicks in after we go to new highs. My guess is, we run up here to maybe 46.50 and back off and then make another run. The whole reasoning behind it, it's the hardest part for investors to grasp. They could buy into a bust up until recently because they could see that the Fed was tightening and that the economy was in trouble. There were a lot of signs that we had, big issues out there, a lot of excesses. But they had trouble understanding how, they said, hey, we made our top in 2021. Why do you think what makes you so sure we're going to go to higher highs? And not only higher highs, but substantially higher highs. And it comes down to, as you said, I'm a contrarian. Sentiment plays a big role in my work. And you had last year, in my 50 years, I don't think I've seen very many times where we've had such a consensus of investors on one side, meaning in this case, the bearish side. And so it was pretty easy to see that at some point we were going to get a very big move in the other direction. And I think we're just beginning that now. There's still an awful lot of, I'd say the vast majority of investors still viewing this as a bear market rally. So yes, they're expanding their upside, but they still believe it ends badly and ends in something, before we get to new highs, ends in something that goes to new lows. I think before this is over, you will see almost all of that bearishness in capitulation and having to reposition bullishly. As you know, institutional investors can stay on the sidelines for just so long, and then all of a sudden performance pressures come in and they can't stay. I mean, obviously shorts have that issue, but any even long only portfolios can't just sit out a market that's starting to move higher. And I think we're at that breaking point now. You're seeing more and more firms raising their equity allocations. Again, it's very early. They're just starting. And sell-side strategists are raising their allocation to equities, all just starting. And I think what's ahead in the summer months and maybe into the early fall is that movement from defensive to more offensive investing. Actually, I think there's a setup, and again, it could either just push through that. I think the real money push comes after new highs, so above 4,800. But I do believe there's a setup where we might see it run to 46.50 and pull back as much as 10% before we go. Okay. I don't have high conviction on that, but I think that's a potential setup. So we may spend a few weeks on the downside before we go, because we're pretty overbought now, and we've certainly in the very short run had an awful lot of movement towards the bullish side. So from a trading perspective, I think, we've seen a shift. From a longer term investment perspective, I still say the vast majority are bearish. My S&P target is 6,000 to 7,000. I think, and people try to challenge and say, oh, maybe it'll even go higher than that. I say that's, my visibility beyond that is impossible. Once you go into a parabolic, it can go wherever it would like in a very short time. But I think 6,000 to 7,000 captures pretty much the probability. And that's a wide range, but that's because we're going to be in a vertical parabolic blow-off. Very, very euphoric blow-off. On the NASDAQ, I am looking for 20,000. That looked pretty crazy not very long ago, but given, the AI euphoria here and I've taken a look at a lot of individual charts, and I can see an awful lot of stocks that not very long ago it was hard to see new highs. I can see major new highs in a lot of major tech stocks, etc. So, the semiconductor index is almost back to its all-time high. So, I think there's going to be a breakout to new highs in a lot of these stocks and also in the average. So, as a macro strategist, I got to stay away from individual names, but I can talk sectors. I think the semiconductors are going to lead the way. I had a target of 400 on this SMH before it split 2-for-1, so 200 on the post-split. I've just raised that to 250, which would in the previous pre-split be 500. That's a big run. That's well beyond the old highs. I think industrials will have a nice run. I think commodities will. The XLB will go on to new highs. I think home builders, surprisingly, are going to show significant new highs. So there's a lot of groups and a lot of cyclical groups. As you know, we've had a narrative out there for a little while here that, this is a poor quality rally, that it's all based on AI and a few tech stocks. Below the surface, if you look, that's not really a true statement. A lot of groups are not far off their highs, and it's not all AI. It's some, like the industrial index is really not very far away. Home builders have had a 50% run since the bottom. So there's a lot of groups that are both up and poised for a lot higher. My target on the Dow is 48,000. My melt-up target on the Russell is 3,000. So I do think small caps are going to have a big catch-up rally as well. In terms of gold and silver, I'm very bullish. I think they've obviously been disappointing, and they've taken their time coming, but they have bottomed, and they've had a secondary correction, and I think they're about to emerge from that secondary correction here, and ultimately probably will top out after the equity indexes, but not that far after, and still be early in the bust or pre-bust. My targets are gold to 3,000 pre-bust and silver to 60 pre-bust. So again, big moves. And people have soured on them obviously quite a bit because of their laggard performance. Yeah, I've been saying, and I'm guilty of this. If anybody wants to go on Twitter, they'll find plenty of critics because it is a melt-up. It will happen in a short period of time. And, consolidations come and stretch everything out. So I thought it could have happened last year and it got stretched out. I'm basically saying we'll probably see most of the melt-up move by the end of the summer, which means could be Labor Day, but it could stretch into September. Could it stretch beyond that? Of course, but that's kind of my best guess right now. As I keep saying, consolidations that last for a month or two just stretch the scenario out for a month or two. So there's no magic to that. I'm not trying to time it precisely. It's the end of a 41-year secular bull market. I date the secular bull back to August of 1982, and I do that. A lot of people try to date it back to 2008-9. I use 1982 because that's really when the disinflation trend began and interest rates peaked out. So you've had this long run of PE multiples expanding inversely to the drop in interest rates. So, 10-year rates went from 15% down to almost zero. PE multiples went from single digits up to, market multiple to mid-20s. So that's to me all one secular bull market. We've had several cyclical bull markets within that. And I think this is the culmination of that 41-year bull market. And I think the highs of this bull market will not likely be seen again for decades. Not a decade, but decades. I would go back to the 2001 to 2011 period. And we obviously had within that period a very large equity rally. And we also had a very large precious metal rally. So it can happen. I know history does point to lots of times when precious metals go opposite to the equity markets, but not always. And I think what's going to probably be a driving element here is uncertainty, certainly. Maybe crypto is not going to be a place to run, or certainly not the conviction run that it was last, couple of years ago. And I do have a very bearish view on the dollar for the balance of this year. So I think that's going to play a big role as well. And of course, we have kicking around. It's not gone away yet. The worries about inflation and precious metals can play a role there as well.